SoFi stock has just hit a new all-time low. And with our stock portfolio primarily consisting of SoFi, let me just say, ladies and gents, that we are definitely feeling this dip. A lot of people have been posting in the SoFi Investors Facebook group that they are down $1,000, $2,000, and some are even down $6,000. Let's be very clear, those are rookie numbers.
Watch and learn, rookie.
We here at Wealth Gambit are down multiple 5 figures. So for all you Sofian soldiers down 5 figures or more, comment rookie numbers in the comment section down below so we know which Sofian soldiers have the highest pain tolerance. And for all of you down less than 5 figures, comment down below, still down bad, so we know who we'll be seeing in therapy. For those of you that sold, in all seriousness though, there is one key benefit to SoFi being at a new all-time low. The upside just got a whole lot crazier. In our opinion, SoFi, despite lowering guidance due to all the student loan drama, just hit major undervalued territory. In this video, we are going to go over 3 key overlooked reasons that shine a light on this insane mispricing of the stock. And for those of you who have been getting absolutely rocked in SoFi like us, this quote is for you. Unless you can watch your stock holding decline by 50% without becoming panic-stricken, you should not be in the stock market. Warren Buffett, aka the Buffinator, not to be confused with buffet, unfortunately. As the timeless saying goes,
it is what it is. It is what it is.
Considering a lot of SoFi shareholders bought in the mid to high teens, this quote really hits home. But fellow SoFi soldiers, we absolutely feel you on this, as we're personally down over 40% on our position and a little more than 40% on some leaps that we own set to expire in 2024. For those of you true Sofian soldiers that are still in the trenches with us, we officially opened the doors to our Patreon on 4/20, aka April 20th at, you guessed it, 4:20 PDT, Pacific Daylight Time. So basically 4:20 p.m. in California. The doors to Patreon will be closing at 4:20 p.m. California time on the 30th of the month, so make sure you do not miss it. Wealth Gambit Patreon will come with Monday through Friday real-time updates and access to our SoFi Investors private Discord. For those of you who are down on your SoFi 20% or more on your SoFi positions, we assure you this is a lot cheaper than therapy. Also, as a token of our appreciation, we'll be shouting out each active Wealth Gambit Patreon member in every single video from the moment they join and after, while they're active members, of course. Now, before we crack into it, please note that we're not financial advisors and this is not financial advice, so always do your own due diligence, or as we like to say here on the channel, doo-doo. Now, according to Investopedia.com, there are 2 ways to calculate the price to sales ratio. One is by dividing the company's market capitalization by a total sales over a 12-month period, and 2 by dividing the stock price by sales per share.
What does this mean?
The lower the price to sales ratio, the better. This means the stock is undervalued.
Highly undervalued.
And in order to know if SoFi's price to sales ratio is low, we'll have to compare it with other fintech companies. We have the market cap of SoFi valued at around $6.08 billion at the time of recording this, and since they have given a 2022 revenue guidance amounting to $1.47 billion, we'll use the forward-looking price to sales ratio as a basis. When you do the math and divide its current market cap to its 2022 revenue guidance, you get a 4.13 price to sales ratio for SoFi. Now, does that mean it's undervalued?
Well, then let's compare.
Let's compare it to one of the fintech behemoths, PayPal, which funny enough, we've compared to SoFi to PayPal in previous videos. One specifically we did 9 months ago, but who's really counting, right? PayPal has a market cap of around $119.97 billion, at least at the time of recording this. In their Q4 earnings call, PayPal announced it's expecting revenue growth of up to 17%, which means the company is expecting revenue to be around $29.72 billion for the full year of 2022. Now, if you calculate its price to sales ratio by dividing its current market cap to its 2022 revenue guidance, you'll come up with a price to sales ratio of 4.03. According to Bloomberg, PayPal has a price to sales ratio of about 4.75.
Well, they certainly look similar.
Macrotrends.net shows that PayPal had a 12.62 price to sales ratio around the same time last year, which means a price to sales ratio of around 4 for this company is like entering the official list of undervalued stocks in the fintech industry. And SoFi, with a price to sales ratio of 4.13, is officially undervalued. And we know what you're thinking, but well, Gambit, price to sales ratio is only one of many ratios used to evaluate a stock. It doesn't even take into account whether a company makes profit or if it will ever make profit. Well, you might want to consider hearing these next two reasons. PayPal and SoFi have similar price to sales ratios at the moment, around the 4s. Yet even PayPal is undervalued relative to its previous price to sales ratios by a factor of 3. The difference between PayPal and SoFi, however, is that PayPal announced its expected revenue growth of around 17%, while SoFi, on the other hand, is expecting to have revenue growth of around 42%. From members to products to Galileo counts, all of these things combined to fuel SoFi's incredible revenue growth. To drive this home even further, take a look at this S-curve chart. So, for the same price to sales ratio of a company that is way further along on its S-curve journey, you can get one at the beginning of its journey. People tend to forget numbers because of outside factors. With most people focusing on the short term, it's easy to get scared and forget the fundamentals. As Joel Greenblatt once said, the secret to investing is to figure out the value of something and then pay a lot less. If Apple came out with a flash sale and sold their new iPhone 13 for $150, would you buy one?
Gonna check on my money.
And you'd probably buy multiple. You know, the value of that iPhone is 10 times higher than the price that it's now at. And that is what we believe with SoFi right now. Reason number 3, SoFi will grow at 10x speed. If you watched our recent video where we talk about blitzscaling and how Tesla used this to go from some random EV company to the most valuable car/renewable energy company in the world in a little over a decade, you would know that SoFi is doing the same exact thing. They're prioritizing growth over early profit in order to become the first one-stop shop fintech company at scale. Anthony Noto is constantly searching for companies which could be incredibly useful for SoFi and the fintech industry as a whole, then eventually acquiring these companies to gain overall control. SoFi intends to be the center of the financial universe, and this means that soon enough it will work as a powerhouse, offering the best of breed financial solutions to its customers and other fintech firms. And this will be made possible with Technisys and Galileo combining to create the ultimate beast, which SoFi, and that's why SoFi acquired both of these bad boys. SoFi doesn't just have the potential to be a one-stop shop for all of their retail customers' need. If they are successful in becoming the AWS of the fintech space, they may just become a one-stop shop for all fintech companies. With SoFi's retail customer market alone, SoFi has in front of it a $1 trillion opportunity. And like we always say on this channel, focus on fundamentals, not noise. Well, here is some fundamental game for you Wealth Gambit viewers. A company will never outgrow its total addressable market. That's why when you look at an S-curve, it typically slows towards the end, which means a company is reaching the upper limits of its total addressable market. Why do you think Apple, who has been killing it selling MacBooks, iPhones, and more, has constantly introduced new product lines and even added things like Apple TV, and even made an Apple credit card? It is to expand its total addressable market. SoFi already has a $1 trillion opportunity with just its retail customers alone. But if you add the opportunity of becoming the AWS of the fintech space into the mix, and you've now almost doubled the total addressable market, and with that, the upside. To sum it all up, SoFi right now is officially undervalued in our non-financial advisor, not financial advice opinion. It is consistently growing, and Commander Noto and his management strategy is working, and very well at that. The market is clearly not reflecting fundamentals. Benjamin Graham, author of The Intelligent Investor, which is regarded as the Bible of value investing, always used to say, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. And currently, the short sellers have been doing a lot of voting. SoFi, priced at $7.26 a share at the time of recording this, is one of the greatest deals we have seen in the market in a very, very long time. And for those of you who think so too, comment, "Me love SoFi a long time. in the comment section down below so we know who the real Wealth Gambit OGs are. And guys, we're Asian, so we can say that. Don't make fun of us. And if you are getting tired of seeing multiple digits of loss every time, then be prepared. As another famous quote says, there's a light at the end of each tunnel, and that light is the light hitting the moon when we get there. Shouts out Light Yagami. Shout out to all of you who commented long SoFi 2021 in one of our previous videos. We greatly appreciate your support to our channel. If you haven't already, make sure to follow us on our social media platforms. We post daily financial news and other relevant news and some dank financial memes. Anyways guys, if you like this video, please smash that like button for the YouTube algorithm and subscribe if you haven't already. And thanks for watching. Until next time, peace.